Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, February 24th, 2022, and I'm pre-recording this Trading Places Live for a bit later this morning. Futures are down a lot. Very, very rough session overnight. Of course, yesterday we broke down below the neckline support on the S&P 500, and the market is paying the price this morning. Currently, we have Dow Jones futures down nearly 800 points. The S&P 500 futures are down 100. NASDAQ futures down 400. Crude oil prices up 7% this morning, almost to $99 a barrel after Russia attacked Ukraine. The 10-year Treasury yield down 12 percentage points, 1.86%. I mean, everything this morning is just absolutely going crazy. Gold up $50 an ounce. That's up to 1,960. Gold tends to benefit whenever fear escalates. And of course, fear is certainly escalating. Speaking of fear, let's see, we have the VIX, which yesterday closed at 31. Going to be a lot higher than that this morning. We'll see where it opens. But point is here, we got a lot of fear. We got the market breaking down, interest rates falling, gold soaring. Going to be quite a day. Most of the commodity space, by the way, is higher. Most of the cryptos getting hit hard, Bitcoin, Ethereum, across the board. Anyhow, a lot going on this morning. We'll try to get to some of this. Obviously, won't have time to get to everything, but anyway, welcome to Trading Places Live. I mean, this is absolutely crazy this morning. Let's go through the agenda for today. We're going to start off with, as we always do, with the daily market recap. Then we'll get into talking technically. I'm going to take a look at the S&P 500 components and just show you where we saw some strength, where we saw some weakness yesterday. Maybe talk about some breakdowns, some stocks that are still holding support, that sort of thing. Get into earnings spotlight next, and then we'll wrap up with the three you must see. Before we get into any of that, though, let's go over to earningsbeats.com. If you are new to Earnings Beats, you can go over to our website, earningsbeats.com. Scroll down. Love to have you in our free newsletter. We do a lot of free events, and this is who we reach out to. We reach out to our free community, along with, obviously, our paid members. But this is a newsletter that's published 3 times a week, Mondays, Wednesdays, Fridays. Very quick read, a couple paragraphs, a chart. All it requires is your name and email address. It's that simple. Hit that subscribe button. No credit card required. You can unsubscribe at any time. We'd love to have you. We have had some free events, letting folks know what to expect this year. I'm hoping that this is not catching anyone by surprise, at least those who follow us at Earnings Beats. We've been talking about this. I was writing articles and doing shows and writing to our members back in December about the potential. You never know for sure. There's never any guarantees, but the potential was there. The warning signs were clearly marked for everyone to see. Had the Market Vision 2022 event back at the beginning of the year. I think that was on January 8th before we had the first really big drop. I don't know how we could have laid it out much different. Now we're in the middle of it. Now it's kind of like, hurricane coming in, category 4, and you want to just stay at home. And then it turns into a category 5 and it hits landfall. And now you have to just ride it out. I mean, this market is going to be very, very volatile. We're going to see some big down days. We're going to see some big up days. If you get it on the right side of both of those, you're going to do really well. Otherwise, it's going to be rough. All right, daily market recap. Let's talk a little bit about what happened yesterday. The Dow Jones Industrial fell 465 points. The S&P 500 down 79. The NASDAQ down another 344. It seems like NASDAQ just goes down 300 every day. Well, except today. Looks like today we might be down 400 to start. Mid caps down 43, small caps down 19. Across the board, you can see lots of weakness. The majority of the weakness was centered on the NASDAQ. NASDAQ was leading to the downside. As far as the sectors go, we had one winner, energy, and probably going to be another big winner today, given the look of crude oil prices this morning. Energy up 1%. looks pretty strong. I suspect probably going to head higher again. We are probably going to do it though with a negative divergence. So I don't know. Once we get up to $100 a barrel or into the hundreds, I got to wonder if that's maybe going to be a psychological lid on energy, but we're going to find out probably pretty soon. The next best sector, there we go, was healthcare. Healthcare, though, lost 0.5%. That was the second best group yesterday. As far as what didn't work, well, it's many of the same old, same old. Consumer discretionary down 3.3%, just falling apart, breaking below the January low. Technology down 2.5%, also breaking below on a closing basis these prior lows. Looks to me like a head and shoulder breakdown on technology. Industrials breaking below its price support. It lost 1.8%. It was just a really ugly day yesterday. And we lost some key support levels. The S&P 500 losing neckline support. That is, you normally from a technical perspective, forget about the war, Russia, Ukraine, inflation, interest rates, forget about everything. When you break down below major support, you've got to recognize that from a technical perspective. And we're going to get into some of those breakdowns in just a minute. 10-year Treasury yield. This morning, we have the Q4 GDP second estimate coming out, expected to come in at 7%. First estimate last month was 6.9. So relatively unchanged from what we saw initially on the GDP for the fourth quarter. Initial jobless claims last week, 248,000. They're expected to drop this week to 231,000. And then finally, later this morning, January new home sales out at 10 a.m. December was 811,000, January 804,000. So a slight drop there. And we're almost in March now, and we're talking about January new home sales. So a little bit in the rear view mirror. Looking at the yield itself, like I said, we're down 12%, or excuse me, 12 basis points this morning. We're down to about 185, 186. Let me get you an update there. Right now, down 12 basis points, 185. I thought we could come down to about 187. So 185 is a little bit on the low end. But with everything so volatile today, who knows what's going to happen with the yields? I would think if we do break and close below this 187 level, that this breakout area around 175, you see that double top there. 170 was another double top in here. We finally broke out above 175. And then when we pulled back, we held 170. So let's just call it 170, 175 would be the next level on the 10-year Treasury yield. This is going to be wild, though, because we got the Fed coming out. Of course, Fed is going to be directing the Fed funds rate, which is a very short-term rate, as opposed to the 10-year Treasury yield, which is on the longer end. But still, when you're fearing inflation, normally the reaction in the 10-year Treasury yield is to go higher. So this is going to be very interesting. The fact that the yield's coming down. Are we talking about the possibility of a recession? Because I've been talking about that that's going to be the next thing that the media is going to focus on. Let's get past Russia, Ukraine. Inflation's now kind of an old story, so they don't get as many clicks on that. Let's move on to recession. That's probably going to be the next one. There's a little sarcasm in there, but they're so predictable. Anything to try and spark fear, guarantee that's going to be the next big topic is going to be recession ahead. Let's move on to talking technically. Start off with the S&P 500. Those of you who've been following me know I've done this chart many, many, many times, so I probably don't need to keep doing it. But I want to make sure for any new viewers that you realize when I talk about a neckline breakdown, head and shoulder, there's your left shoulder. Here's your neckline. Went all the way back up here, put in a head, which was the top. And you might say, well, how do you know there that it's the top? Well, there are other signals. When we broke out in December right here above that November high, if you recall the month of December, guess which sectors led during that month, setting an all-time high. I can tell you it wasn't technology, it wasn't consumer discretionary, it wasn't communication services, it wasn't financials, and it wasn't industrials. Those are our 5 aggressive groups. None of them were in the top 4. This final break to the top side here was led by consumer staples, healthcare, real estate, and utilities, the 4 defensive groups. And I tell you, when the overall market is being led higher by those four groups, you got problems on a relative basis, and on an absolute basis. And we were being led by both. Anyhow, that was a major warning sign. We had negative divergences on the weekly charts. That's a warning sign. It all started coming together. We had a rough January. If you were at our free January Effect webinar that we talked about, that was back at the beginning of February. I said, when you have a bad January, the tendency is you have a bad rest of the year, at least not a great one. That's the tendency. And so here we are in February, breaking back down again. Anyway, the rally into the right shoulder right here was not a very impressive one. The money was not rotating back in any big way to aggressive areas of the market. And so we turned right back over, rolled over, and broke down now below this neckline. The big key here is the measurement. So I've talked about this, why I believe it's a cyclical bear market. And one of the reasons is that I believe we were going to break down out of this pattern. So let's grab this right here, drag it to there, roughly 10.81% from the head down to the neckline, which means when you break down, you can drag this down right there, and 10.81% will take us down to about 38.40. So back in Market Vision 2022 on January 8th, I gave an initial measure. Well, the first thing I said was I felt like we'd have a minimum downside of 4,300 to test this low. And then I said, if we broke that low, then we would be looking at a minimum target of 3,800 roughly. And this is where this came out of. I think we're heading there. I think we're going below 3,800. My guess, 3,500, 33 to 3,500 would be my best guess, maybe 33, 3,600, somewhere in there. But your minimum target based on this head and shoulder breakdown is down at about 38.40. Now, do I think we're going to be at 38.40 at the end of February, end of this week? No. Could we? Yes. I mean, I've seen when the VIX is this high, and I don't know where we're going to open today, but the volatility index, when you get up into the upper 30s, mid 30s, upper 30s, or into the 40s, it is like market makers are like matadors. They got that red cape out and, letting the bull right on through. Well, not the bull, the bear in this case. But yeah, I mean, when you get a high VIX, I call it market makers going on vacation. Why would you want to try and stand in front of a freight train when the market is going down as fast as it is right now? And there's so much supply, so many shares being sold. Why would you want to step in front of it? So we'll see what happens. Now, you want me to give you the silver lining? Because I was very surprised that we didn't have bigger volume. I mean, that volume is just kind of average for what we've been seeing. I mean, we've had the move down in January was big volume, huge volume, 3 to 4 billion shares. Yesterday, 2.5 billion. That was a little odd. So at this point, what I would say is respect 4,300 resistance, number one. If we manage to get through 4,300, watch the 20-day moving average, which is now at 44.36. Those two levels, to me, are the key levels to watch on any bounce. A normal bounce to those two areas that mean nothing to me. If we get through both of them, then maybe this was a false breakdown because of the light volume. And I'm saying it kind of like, I don't know. There's so many other signs telling me that we're going lower, but I'm just trying to throw out the silver lining. Volume was light on this breakdown. Normally what we look for confirmation on a head and shoulder breakdown is very heavy volume. We did not get that. So I'll give you both sides, but I still believe the market's going lower. That's my take on things right now. Now, back at Market Vision 2022 in early January, this is one of the charts that I pulled up. And I marked the bottom. And if you notice, if you take this exact same line and just drag it up to the top, you'll see that it marks most of these highs as well coming across. But after the big, huge drop in the pandemic and that massive rally, we actually went outside the channel, which to me presents even more risk. Well, we're not outside the channel anymore. And this is before today's futures, which are showing we're going to have a big drop. What I was looking for was potentially a drop back down into the middle of this range, potentially 3,500, maybe a little higher as the channel, moves out further into 2022. So this kind of aligns similarly with the head and shoulder projection and some of the other projections that I made. If you look at this light dotted blue line, it connects some of the key lows outside of the pandemic low. It really highlights some of the major lows. Here's the Q4 2018 trade war low. That was a cyclical bear market, by the way. That was 20%. We went down, and we marked that essentially right on that line. And so throughout the last 13 years, we've really only had one significant decline below this line. And that marked what I consider to be a generational low. I don't believe we're going to see that ever again. But could we get back down to 3,500? Yeah, I think we could get back down to 3,500. 700 points to go, and we're probably going to get 100 at the open today. So, yeah, I don't think that's that far off, to be honest. The other S&P 500 chart I wanted to show you, this is where I actually did a projection from January 8th. This is what I was kind of looking for back then, was that drop right to here. Maybe it happens sooner. I would say maybe this happens by April. But anyway, moving down into 2022 and then rising again later in the year. That's what I expected then. That's what I still expect. I think what's going to happen, I think many of these growth stocks, because everyone's fearing the Fed right now, interest rates, everybody's adjusting their models with higher interest rates. I think that's fine and dandy if that's what they want to do now. I think what the 10-year Treasury yield is telling us is that we're more worried about recession than we are inflation. And when the Fed figures that out, the Fed's going to stop raising rates and it's going to lower rates. And when they lower rates, guess what happens? All of these growth stocks that are getting absolutely pummeled right now are going to be much more in favor, because the valuation models are all going to change when we start saying, oh, guess what? We're not going to have all these rate hikes. The Fed screwed up again, like they did back at the end of 2018 when they said we were going to have 2 rate hikes in 2019. And instead, they cut rates in July of 2019. This isn't new for this Fed, by the way. We're not charging in the new territory here. The Fed screwed up at the end of 2019 or 2018, the trade war, that 20% pullback or cyclical bear market, in my opinion, was orchestrated by the Fed. They're the ones that did it. If you look back, their wording, when they got hawkish, that's when the market collapsed. Why? Because when you start doing these valuation models and you have interest rates that are starting now, you're going to talk about higher interest rates, that's going to affect your discount rate, and it's going to affect the present value of your future earnings and future cash flows. Valuations drop when rates go up. So it was a very quick move back in 2018 to the downside. And then when everybody realized, oh, the Fed screwed up, they're not going to raise rates, then the market came right back. Voila, magic. Well, I think we're going to have a similar thing in 2022. Maybe I'm wrong, but this is what I'm sticking with. Yes, inflation is a problem short term. Yes, the Fed probably should raise once. I think the March rate hike is probably what they should do. Beyond that, they should probably just be saying, hey, there are other indications, consumer confidence falling, we might have a recession. If we do, demand's going to go down, and guess what? That's going to take care of inflation all by itself. So we're going to raise, and then we're going to watch and see what happens. But I don't think that's what they're going to do. I think they're going to raise. They're going to talk about more raises. We're going to be in the midst of this next cyclical bear market. And then the light's going to shine on the Fed. And the Fed's going to realize what's going on. And I believe recession becomes the bigger word. And that's going to scare everyone. But you know what? While all that talk's going on, Wall Street's going to be accumulating growth stocks, because growth stocks are going to go up when rates come back down. Anyway, that's a lot of predictions in there. Who knows? Maybe none of them come true, but that's what I'm seeing right now. That's the way I'm approaching the market. I've been saying cash, gold. Those are the two things that you should be thinking about in this market. As a trader, because I get questions a lot of times about our portfolios. Well, why are you doing these portfolios? Why aren't you in cash? The portfolios are designed for buy and hold. We invest 100% in our portfolios at all times. At all times. We change out the stocks every 90 days. So don't confuse that with what I'm talking about from a trading perspective. From a trading perspective, I am not comfortable in anything right now other than gold. And you see why this morning. Dow futures down 800. We lost neckline support. Technicals have been screaming to us that we're going lower, or at least that there was high risk that we were going lower. All right, let's take a look at the S&P 500 components. So this is just a summary form of what happened yesterday. So here were the stocks that actually did well yesterday. Not a whole lot of them, by the way, a couple 4%ers, a 3%er, and then we were down 2%, 1%. And we don't have to go down very far before we start getting into the red. Remember, there are 500 companies in here. There were probably 40 of them, 30 or 40 that were actually in the green yesterday. All the rest were in the red. So when you look at the red, pull these up. Tesla was the big loser yesterday, down 7%. Moderna, 6.37. Moderna reported this morning. They were down 3 or 4% with their earnings. Not as much as I thought they might be, but we'll see where they are by the end of the day. Anyhow, these are the losers, and you can see a lot more big losers yesterday. 7%, a couple 6%ers. Here's what 7 or 8 5%ers. Then you get into a bunch of 4%ers, a ton of 3%ers, and so forth. If you look at some of these scooters, and I would maybe look at some of the ones that are over 50, say there's AMD. So this scooter was over 50 even after the drop yesterday. So it was probably a lot higher earlier in the day. I would pull that up. That's probably a stock that's breaking down or on the verge. Well, we failed at the 20-day and started to roll back over beneath these recent lows. Certainly looks like AMD is going to head back to 100. And who knows, maybe we'll get there at the open or shortly after the open today, because it is in a growth stock area. And the growth stocks, I don't care what you have in terms of your earnings. When we go through the earnings spotlight here in a couple minutes or in a minute or two, I'm going to just show you some of these stocks and how badly they're getting hit today. I can promise you they're not all reporting bad news, but they're growth stocks. The futures are down, and we don't care about what you did last quarter. Again, if there's a recession ahead, the market's looking ahead. So great, you had a great quarter last quarter. Well, that's old news. Now we're looking at the new news. And that's why the market is going to sell off and probably continue to have downward pressure for the next couple of months. And there will be rallies, by the way. I don't think we're going to go straight down. We could. Sometimes we have these big moves, 5 or 6 days of just pain and torture. Maybe we go straight to 3,800 from here. I don't know. But I do think we're eventually getting at least that low. And it could be choppy. It could be very wild, volatile action. So you just have to be careful if you're trading or trying to trade this. So AMD, how about, let's see if we can find another one here, and then we'll move on. But when you can drop the, if you're a StockCharts member, you can just go in on your scans and just pick the S&P 500 and drop it right into a chart list. So that's how I did this. I just dropped it right in the chart list. See what else. Here's another one. That's another semiconductor. Here's an airline, Delta. Let's see what Delta did. That was pretty high. I mean, Delta, the airlines were doing pretty well, but it did lose this short-term price support. Now it's down to the 50-day. You got trend line support coming up. I would be very nervous if Delta loses $39, and we might see that today. So, even some of these stocks that have, pretty high scooters are decent. They're not really high, but they're decent. Let's see, Micron. Okay, Micron, 86 on the scooter. This will be the last one here. Well, we put in a nice little cup, almost got to the high, so maybe not quite a cup, but this handle is already looking pretty weak to me. I would have definitely wanted to hold the 20-day. So it looks like, I think, maybe sideways consolidation. The top established at 97.5. The recent low also gap support down around 77.5. My guess is Micron is going to gravitate back toward the bottom of this maybe sideways pattern. If it breaks 77.5 on the close, or maybe 77, whatever that gap support is, if we lose that, then I think you go back down to about 66. But In the short term, I would be looking maybe 97.5 down to 77.5 is the range. All right, let's talk a little bit about the earnings that came out. I'm just going to rifle through some of these real quick for the earnings spotlight today. So there's FIVN 59. Let me get an update on this, see where we are. 1358, 1550 now, down 1550. These are all companies that reported either yesterday after the close or this morning before the opening bell. Booking Holdings, there's down 7.25%. eBay down 8.4%. Network Appliance, NTAP, down 8.4%. BMRN, this is Biomarin Pharmaceutical, down 5.5%. Bath and Body Works. I always get this one confused. Actually, I was showing this one down 8% earlier, but it's now, or 9% earlier, showing flat right now, but I don't think that's correct. FLGT, this is Fulgent Genetics, down 12.7%. Skillz, this stock's been getting absolutely torched. It's very heavily shorted. No way it's going to go down any lower, right? How about another 38% this morning on Skillz? Magnite, MGNI, down 8%, software company. Sleep Number, down 14%. BAN, this stock a couple years ago after the pandemic was on fire. It can't find a bottom now. The bottomless pit down another 11.6%. CBRE, this is in the financial area, I believe, and that's down, only down 2%. I thought that was down more earlier. Wayfair down 12%. Then you also got Papa John's. Apparently not too many folks liking their pizza these days, down 20%. On the other side, one of our stocks from, I think I'd pointed this one out last quarter, last month, but LNTH, this was a stock that I had traded previously. Anyway, stock up 28% with earnings. So we are seeing some, but just not many moving higher. All right, let's move on to the three you must see, and I'm going to do these pretty quick. Cisco, I'm going to give you 3 Dow stocks that did not do very well yesterday. Cisco actually came back up. It's been holding this area of support. The AD line looks really good, well, at least until yesterday. I suspect Cisco is going to hold around $52, but if the overall market takes a big hit, who knows? But Cisco did have a rough day, went back below its 20-day yesterday, which is worth at least monitoring. The second stock that I had for you is Apple. I wrote about Apple in my blog recently. I was saying this could be the catalyst. Well, Apple is likely to break down below key support today at 158. I have a target on it of 140. I think we'll eventually see it. And then Caterpillar is the last one I have for you. And Caterpillar breaking down below these prior lows, but look at all these lows over here. With today's futures, we may be seeing a very, very significant breakdown on Caterpillar at the open today. All right, that's all I had for you today. Please be careful out there. The market is absolutely a mess. And again, if you want help with some guidance, I mean, we do have the free newsletter over at Earnings Beats, which I would really strongly encourage you to consider. All it takes is a name, email address, and we'll make sure we get that out to you. No credit card required. You can unsubscribe at any time. Anyhow, that is it. Hope everybody has a great day. It's going to be a little rough, rocky start for sure. Maybe we'll rally off the opening low. Who knows? Anyhow, that's it for me. Take care. I'll be back on Monday of next week for your next Trading Places Live over at earningsbeats.com. You can, if you are over at Earnings Beats on Monday and you want to listen in, just come in anytime after 8:45 Eastern. Click on this Trading Places Live and you'll have a link that you can come right into the room. Anyway, have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.